Bonjour tout le monde. Good morning, everyone. My name is Paul Bennett, and I'm a director on the board of the Ottawa branch of the National Association of Federal Retirees. I would like to begin by acknowledging that the land on which the branch office is located is traditional unceded territory of the Algonquin Anishinaabe people. On behalf of the branch, I'm pleased to welcome you to today's webinar, the first of three that our presenter has called Three Secrets of Successful Investors. Today's topic is High Fees Don't Guarantee Better Returns. Our presenter is none other than Michael Fine, who is a branch member and a bit of a legend. Over the last 5 years, Michael has designed and offered very popular workshops and webinars on investment matters that have reached over 1,600 members. He is a former provincial deputy minister and federal director general. Michael spent about half of his career abroad, which gives him a unique perspective on the world's economy and Canada's place in it. Michael has an MBA and has successfully completed the Certified Financial Planner course, although he has never worked in the industry. Michael has spent a lot of time managing his own family's financial assets. His views are his alone, and he receives no remuneration for these events. He is dedicated to helping retirees get the information they need to make well-informed investing decisions. Now, before I turn things over to Michael, I do have a few things to mention. I need to remind you that the webinar will not provide investment advice, and Ottawa branch takes no responsibility for any investing decisions that participants may make. Veuillez noter que le webinaire sera présenté en anglais, mais la participation bilingue est toujours encouragée. I also want to give a special welcome to anyone who is not yet a member of the association. We hope these webinars will inspire you to join us. And we hope that these webinars will encourage our current members to maintain their membership. Something important to note is that our mega recoupment drive is back. From now until December 31st, every time you successfully recruit a new member, you will receive a ballot to win one of 14 great prizes, including a grand prize of $10,000 in cash, courtesy of Johnson Insurance. All members who successfully recruit a new member will also receive a $5 Tim Hortons gift card. There are no limits to the number of times you can be entered into the grand prize draw, so the more new members you recruit, the more chances you'll have to win. After today's webinar, the Ottawa branch will send you an email with instructions on how to access the recording of today's webinar, more information on the mega recruitment drive, and how to join the association. Remember too, that you can always invite non-members to register for our webinars as guests and try us out for free. There will be a question and answer period at the end of the webinar. Please type your questions in the chat box throughout the session, but particularly following the PowerPoint presentation, and Michael will answer as many as he can during the Q&A period. I am now going to turn the presentation over to Michael.
Thanks very much, Paul. Thank you for that kind introduction. Good morning, everybody. I just wanted to reiterate a couple of things. Paul mentioned that I don't work in the financial services area. I don't get any remuneration for this. I don't sell any products. So the good news is that whatever I share with you are things that I personally believe and personally adapt for my own assets and my own investments. And I think that's a particularly important thing to say today because unfortunately, one of the things I have to tell you up front is that I think the next 3 to 5 years are going to be very tough for investors. And as we go through the presentation today, I'll tell you a bit about that. But for example, one of the things that's happening later today is that the Federal Reserve Bank of the United States is announcing its latest increase in its lending rate. And I would recommend to you that you keep an eye on that. Most people expect a 0.75% increase. It could even be a full 1%. But the fact is that inflation in the United States remains out of control and that the Federal Reserve Bank has got to get it back into control. And the only real way they can do that is by increasing interest rates. So it makes, I think, the message that I'm going to give you today even more important, which is that in an environment of probably restricted, low, even negative returns, you really cannot afford to overpay for your investment advice. And that means that one of the things you have to try to avoid at all costs are high fees. So that's the basic message today. Avoid high fees, and I'm going to show you how. So give me a minute to get the PowerPoint going here. All right, and I just have to figure out how I get this screen to share. Okay, so we're ready to go. So today's topic, as we discussed, is low fees equal better returns. Just to reiterate what has already been said, but this webinar does not provide investment advice, even though it may sound like it. All investing comes with risk. And as I mentioned, I think particularly over the next 3 to 5 years. And before making any investments, please consult a qualified financial advisor or do your own extensive due diligence. So where to start? First of all, one of the issues is that mutual funds, which is what most people end up investing in, particularly if they go to their bank branch, woefully underperform the market. And these are recent statistics from SPIVA. SPIVA stands for Standard & Poor's Index versus Active, and it measures the performance of actively managed mutual funds. And you can see that according to SPIVA, over the last 10 years, only 17% of Canadian stock mutual funds beat the market. And if you're looking at dividend stock mutual funds, that number goes down to 6%, 4% for US stocks, and 5% for global stocks. So that means that overall, in a diversified portfolio, you've got about a 10% chance of finding a mutual fund that's going to beat the market. And those ain't very good odds. So you might say, well, look, I can just buy the best performers. I can buy that 10% or so that does beat the market. Well, a couple of problems. Number one, your bank branch, frankly, doesn't sell the best performers because they don't tend to be the ones with the big bank investment companies. The second thing is that past performance is no guarantee of the future, because what happens is that most of the funds that beat the market are successful small funds, but through success, they become less successful big funds. Successful managers get hired away by the bigger funds. And then a lot of the funds that are successful were successful because they had certain sector bets, such as the tech sector. And these often get superseded over time by a different sector. So it's very hard to buy the best performers and expect that you're going to still get good performance. So we're going to start right now with a poll question. And the basic poll question is this: the average annual fee charged by actively managed Canadian mutual funds is twice that of the US. It is how much? Please vote. Okay, I think everyone who's going to vote has voted. So you can see that there's a tie between 2 and 3%. And the correct answer is about 2%. And the interesting thing is that in the United States, where there's more competition, the average fee is about 1%. So 2% is what you are paying going forward. Now, you may not think that 2% is a lot, but over a long period of time, 2% makes a lot of difference. So for example, at 2% per year compounded, that means that over 10 years, you're paying 22%. 22% of what you could have is going to whoever's running that mutual fund. Over 20 years is 49%, and over 30 years is 81%. So it can have an enormous impact on the results of your investments. And as I say, 2% doesn't sound like a lot, but it sure adds up quickly. On the other hand, exchange traded funds, or ETFs, have much lower fees. So what is an exchange traded fund? People seem to still have problems wrapping their head around this. It's basically a mutual fund, does the same thing, holds a group of stocks or bonds or other things. But here are the differences. ETFs, because they're bought and sold like a stock, don't have trailing commissions that are typically built into mutual funds. And those trailing commissions are about 1%, sometimes higher. So for example, whoever sold you that mutual fund, they're getting 1% of those fees every year that you hold the fund. Also, ETFs have much lower admin fees. Originally, they were focused on super low-cost index funds, so that also reduced their fees. Today, many are available as actively managed funds, similar to most mutual funds, but again, with much lower fees, and I'll show you in a minute. And they have the same level of security or risk as mutual funds. So they're mutual funds, just that they're bought and sold like a stock. So here's another poll question for you. What is the typical fee charged by Canadian stock market tracking passively managed ETFs? So what is the typical fee charged by Canadian stock market tracking, that means index, ETFs? Please vote. Okay, I think most people have voted. Now, you remember I said that the average fee charged by an active mutual fund was 2%. The typical fee charged by a Canadian stock market tracking, like index tracking ETF, is 0.05%. That's 0.05%. So that's about roughly, what, 1/40th of the fees charged by an actively managed mutual fund. And what I'm going to show you is that those fees charged by the actively managed mutual funds, the higher fees, do not get you better performance. So let's look at a typical comparison here. So in mutual funds, the active funds charge about 2%, and the index funds, because you can get mutual funds that track indexes, charge about 1%. Actively managed ETFs charge about 0.8, so about half. And the index ones, as I mentioned, charge about 0.05. And by the way, mutual fund and ETF fees are called management expense ratio, because of course, the investment companies don't want to call them fees. But management expense ratio, or MERs, are fees. So let's look at a couple of big Canadian equity mutual funds and their returns. So I just took two at random. The first one from RBC, Canadian Equity, big fund. You can see total assets, $2.3 billion. Here's the MER, the fee, 1.9%. So over 10 years, the return was 91%. Not bad. Then I looked at a TD Canadian equity, which actually has 7.5% US in it. And the US market did a lot better than the Canadian over the last 10 years. So you can see its returns a little higher. Its MER is 2.2, $6 billion. Now look at this. These are the fees that this fund generates. $132 million in fees from that one fund going to TD. Now, you would think, and I'm sure you do think, Michael, $132 million, they got to be able to hire the best investment managers in the world. They got to be able to beat the market. I mean, they're getting $132 million. Let's see. So here is a couple of index ETFs. The iShares TSX 60, its symbol is XIU. It tracks roughly the 60 biggest companies on the Toronto Stock Exchange. And you can see the MER is 0.2, about 1/10, and you can see total assets. And then this one is the TSX Composite. It's the whole 250 companies in the TSX. Symbol is XIC, and you can see its MER is 0.05, and it's got 8.6 billion. So let's see how the performance compares. So the 10-year return of the XIU beat both of these managed mutual funds by about 28%. And the TSX Composite XIC beat them by 69%. So these are ETFs that simply track the index. They don't try to pick stocks. They don't do anything. They just have a computer that basically tracks the index and adjusts as the price of stocks in the index go up and down. So this is your fund that charges $120 million or so in fees, and it can't beat the index. And one of the reasons it can't is because of the high fees. So if you look at this, the difference between here and here, that's over 2%, times 10 years, that's 20%. That accounts for a certain portion of the fact that they couldn't beat the index. But even taking that away, the index still beat them by over 40%. So why can't they beat the index? Well, here's a reason. These big active funds are basically what are called closet indexers. If you look at what they hold the same things that are in the index. So for example, the two largest holdings for the RBC and TD are exactly the same. RY is Royal Bank, are the same as what's in XIU and XIC. And the next largest holding, TD, again is the same. And if you go through these, you'll see that virtually all of these are contained somewhere in the indexes. So CNQ, Canadian Natural Resources, is down here. Enbridge is over here. BMO is over here. And the reason for this is that Canada is not a big market. So if you're running a multi-billion-dollar fund, you've got to invest in these things because frankly, there's no place else to put your money. So that's why they have a very hard time beating the index, because to a great extent, they are the index. The other thing to be aware is that if you go into your friendly bank branches only sell mutual funds and GICs because that's all they're licensed to sell. They can't sell you ETFs and other low-cost investments because these are available only through online discount brokers and robo-advisors or traditional brokers. So I came across this video that basically gives you an example of what it's like when you go into your bank branch shopping for investments.
French fries, please.
No, no tuna.
You're out of tuna?
No tuna. Cheeseburger?
Wait a minute.
Cheeseburger? Come on, come on, come on, come on. We got it all day. We ain't got it all day. Okay, we got to turn it over. Turn it over. Okay, what are you gonna have?
I think I'll have grilled cheese and a Coke.
Grilled cheese?
No grilled cheese.
No grilled cheese.
Cheeseburger and a Coke.
No Coke. Pepsi.
Okay, Pepsi and French fries.
No fries. Cheap.
Okay, cheap.
One cheeseburger, one Pepsi, one cheap.
Cheeseburger.
Pepsi, cheap. What do you want?
I'll have a cheeseburger and a small Coke.
No Coke. Pepsi.
Pepsi.
One cheeseburger, one Pepsi.
Cheeseburger.
Pepsi.
Cheeseburger, 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 4 Pepsi, 2 cheap.
Cheeseburger, cheeseburger, cheeseburger.
Two Pepsi, one cheap.
Hiya, Keith.
Hey.
I'll have the usual.
Cheeseburger.
Cheeseburger.
So anyway, other than the date on that, you notice everybody smoking at the restaurant. The first time I saw that, I thought, God, it's amazing. We used to do things like that. Anyway, that's what it's like when you go into your bank. You get a cheeseburger. The other thing I wanted to tell you, and getting into the point why I think the next few years are going to be tough for investors. And luckily, most of the people on this are old enough to remember this. But basically, interest rates have been falling until recently for the last 40 years. Now, we're all old enough to remember back to 18% mortgage rates in the early 80s. But this is a graph showing you the interest rate in the 10-year US government treasury bond. And you can see that from roughly 82, with ups and downs, but basically all the way down to about 2020, interest rates declined. But as you know, interest rates have started to go up. And what people don't realize is that this decline in interest rates drove a huge amount of the increase in asset values, real estate, stocks, bonds, all of that. And it's because, well, for example, in the case of real estate, people's mortgageability, what they could get in a mortgage for the same monthly payment, accounted for something like 40% of the increase in housing prices, excluding inflation and excluding people's higher incomes. And the same thing happened to the stock market. And that has had an enormous effect, and that's simply not going to happen anymore. Why? Well, interest rates, say here, as we show here, went from about 16% to roughly 2%, so it went down by 14 percentage points. Well, you can't go from 2 to minus 12. You can't have minus 12% interest. So I want to make the point that the last 40 years were an exceptional period, and they're over. So, as I said, stock prices were driven by the same sort of factors that drove housing prices, that people didn't have any other place to put their money, valuations of companies increased, and these stock values were enormously increased. How much? Well, show you how expensive stocks are today relative to 40 years ago. This is a little bit old, but it basically holds true. In August of '82, the price to earnings ratio of the Standard & Poor's 500, the 500 largest companies in the United States, was 6.7. So price to earnings ratio simply takes the price of the stock, divided it by its earnings per year per share. In August this year, that ratio was 21 times. And this is a basic measure of how expensive things are. So essentially 3 times more expensive. The dividend yield back then was 6.7 versus 1.6. And this is another interesting indicator, what they call the Buffett indicator. The total value of the stock market compared to the GDP at the time was 32%. In August, it was 170%. So all these factors show that the stock market is still very expensive. This graph shows you what stock market returns have been like since 1928. The orange line is the average, which is about 9.5%. And that's the return on stocks plus dividends. But you can see that there's a huge dispersion around this. And you can see that the last 10 years, 7 out of 10 of those years have been here above the line. And there's a basic mathematical principle, statistical principle called reversion to the mean. The orange line is the mean. And so what it simply says is that if you've got a bunch of years that are above the mean, you got to have a bunch of years that are below the mean to end up back to the averages. One point I want to make is to combat this, there is a way, even in a market that goes nowhere, to still make money. And here, if you look, this red line shows the S&P 500. The blue line is the same return if you had reinvested all your dividends automatically in a tax-free account. So if you look here from about March 2000 over here to March 2012, the S&P 500 did nothing. It went down, it went up, it went down. It was back in exactly the same place 12 years later. But if you had just reinvested your dividends, it went from 2,000 here to 3,000 here, an increase of 50% in the same period. So my point is that even in markets that go nowhere, a strategy that reinvests your dividends automatically, which forces you to buy low, in the end can still make you a decent profit. So next poll question. If you knew for certain in February 2020 that COVID was about to shut down the world and kill millions, would you have sold all your stock investments, sold half of your stock investments, done nothing, or bought more? Please vote now. Okay, I think everyone has voted. So interestingly, the right answer was either do nothing or bought more. But the real answer, probably most of us would have said, I better sell stuff. The world is about to stop. The point of asking this question is to simply say, even though we may know what's going to happen at a macro level in the world, it's not necessarily a good indicator of what's going to happen in the stock market. And so sometimes doing nothing, which 43% of you said you would do, is the right answer. And that's basically what we're going to come to. So that's the end of today's session. I just want to reiterate two things. Number one, that in a world of potentially low returns, markets that don't do much of anything, there are two strategies that still work for you. Number one is keep your fees as low as possible. Number two is reinvest your dividends automatically if you're particularly in a tax-free account, and do nothing. Next week on September 28th, we're going to talk about the third approach, which is that you use smart tax strategies so that you keep more of the money you earn. And then on October 5th, the final piece is going to be looking at diversified portfolios, low cost, that take the work out of investing and basically help you to hopefully profit even in a poor investment environment. And with that, I'll stop and turn over to questions.
Great. Thank you very much for that excellent presentation, Michael. We have 3 questions so far, and I'd be interested in your response to the first one and whether you want to get into a detailed one about a specific Bank of Nova Scotia. Are there iShares sold by the Bank of Nova Scotia actually ETFs?
I guess it depends how they sell them. I think it was iShares that are sold through actually Royal Bank rather than Bank of Nova Scotia. And what they've done, I believe, is they've taken a group of ETFs and packaged them into mutual funds. So they can't sell ETFs. So their way around it was take a bunch, put it into a mutual fund and sell the mutual fund. I don't know what the fees are like on those. And I'm wondering if the fees are such that they basically eliminate the benefit of investing through ETFs.
All right, thank you. The second question, is it worth taking the capital gains hit in order to convert an existing investment portfolio actively managed with an MER of 1.3% to an ETF-only portfolio, either passive or active ETFs? Would the short-term pain be recouped by the long-term savings in MERs and better returns with the ETFs?
Yeah, that's a good question, and it's one I've looked at myself. And the answer is, of course, it depends. First of all, it would be far better to do it in a non-taxable account. So if you're in an RSP or RIF or TFSA or something like that, there it doesn't matter because you're not going to get hit with capital gains tax. If you're going to get hit with capital gains tax, and the difference is, perhaps 1%, it could take a number of years to make up that difference. And it depends how big your capital gain is. Typically, if you've got 100% capital gain, you're going to be paying about 20% tax on that by the time you're finished. So if you got 100% and you're only going to save 1% per year, it's going to take you 20 years to recoup that difference. That's not something I think I would do.
All right, thanks, Michael. What about a financial service like Investia? Yes, there are mutual funds, but returns have been good until this year. I do know that their fees have been hidden until they're required to disclose in their annual report. And we are now finally, perhaps, at the age where we really need their advice on how to manage our dollars. Can you get that from a robo-investor in ETFs? Our advisor, of course, says no.
Yeah, I think, again, it depends what kind of advice you need. Financial advisors do provide some very good advice when it comes to retirement planning or cash flow needs or tax planning. And if you're getting that sort of advice from a financial advisor, then it's probably worth sticking with it. But if all you're getting from a financial advisor is buy the following ETFs, you might as well do it yourself. So I think the best way to answer that question is for individuals, look at the package of investments that your financial advisor has put you in and ask yourself the question, essentially, can I do this myself by going to a robo-advisor, or even better, going online, opening an online account, which we'll talk about in week 3 how to do, and just buying these ETFs yourself.
Okay, the next question. If you still plan on staying with the bank and are moving your RRSPs to, I think that should be RIFs this year, what are your suggestions on where to put this money through the bank avenue?
Well, that's a tough question. One of the things that we'll talk about in week 3 is how seniors need to be able to plan for the next number of years. My approach is to focus on high dividend yielding investments, because I suspect that over the next number of years, there may be very little capital gain. The problem is that if you're with a bank and you're doing it through a bank branch, what they have to invest in is very limited. For example, at least 2 of the big banks today only sell their own products. They won't sell you even mutual funds from another provider. And I'm not sure that those funds that they sell, the mutual funds that they sell, are good if you're looking at high dividend income, for example. So if people are staying with their bank branch, I'm not sure how you do it, quite frankly, because I'm not sure they've got the right products.
All right, that's very frank. This is just a reminder to participants that they should put their questions in the chat box, any that they may have, and any questions submitted that haven't been answered by the time of the end of today's session, you should send on to us, and I'll give you the email address, and hopefully we can get back to you with answers to that. The next question is one which I know I've certainly been thinking about. I'm an investor, but I'm thinking of buying GICs. What is your position on GICs?
Well, certainly GICs are a heck of a lot better today than they were a few years ago, where I think you can get up to 4%, 4.5% perhaps today, and they may well go higher. Look, there's absolutely nothing wrong with GICs, particularly if they're in a tax advantaged or tax postponed investment such as a RSP, RIF, TFSA. The problem with GICs that I see are twofold. Number one, you're not going to keep up with inflation at 4%. If inflation continues for some time, 7, 8, 9%, where dividends actually are, in many cases, are higher. And you can actually do better with dividends than you can with GICs, albeit with a lot more risk. If you're in a taxable account, your GICs get really whacked because, as I'm going to show you next week, and I hope you'll tune in next week, the taxes on interest are significantly higher than the taxes on dividend income. And particularly for people who have a personal taxable income of under, say, $78,000 a year, it makes a huge difference in what you keep in your pocket. So, as in all these things, Paul, the answer is always, it depends. And it depends on your personal situation, and it depends on, is it a taxable account or not? But my rule of thumb is typically, I don't like GICs in a taxable account because I end up paying 50% of it in taxes.
That's pretty stark. The question of fees has certainly come to the fore over the last few years. And here's one from, I think, a Canadian in Jamaica. I use a TD Evergreen private investor who charges my portfolio about 1.1% per year. He says that any trading costs are included in this fee, but what about MERs attached to the funds he has me in?
Yeah, typically the MERs are extra because they're embedded in the cost of the funds. So whether you're buying ETFs or whether you're buying mutual funds, those returns that you get are after the fees are extracted. So whether those funds make money or not, guess who gets paid first? The people running the funds. So in any case I've seen, the fees are in addition to the fee you're paying your advisor.
All right, thank you. Another question. Would you speak to the advantages of following a RIF drawdown strategy that progressively diverts funds into a TFSA, providing one has room?
Well, again, it depends on the individual. The thing with a RIF today is that you have a minimum annual withdrawal. Typically for people around 70 or so years old, because you have to start withdrawing from your RIF at 72. I believe the minimum is around 5.2%, goes up every year. I think from the number crunching that I did, because we have it in our own family, it's better to leave your money in the RIF until you have to take it out. And when you do take it out, based on that minimum withdrawal, and you don't need it, and you have contribution room, rolling it into a TFSA makes a lot of sense. But typically, because of the tax hit, because going again back, when you withdraw from a RIF, your tax rate is the highest marginal tax rate available. You get fully whacked. And if you're at a higher income level, you can be paying 40% or more on those RIF withdrawals. So typically it makes more sense just to leave it in there and let the hopeful capital appreciation or dividend payment accrue over time.
All right, thanks, Michael. We likely will have room for a few more questions. So if you want to put them into the chat box, I'm sure Michael will be pleased to answer them. And here's one. Is the BTSX a good way to simplify your dividend investment strategy? If you simply follow the BTSX, it simplifies investing, right?
Well, I'm not sure what the BTSX is. Maybe the questioner can send us a follow-up chat and tell us what the BTSX is. Do you know, Paul?
No, I don't offhand. No. I've been doing a little bit of research as we go along on some of the terms, but that I can't, or some of the acronyms, but that I can't tell you.
No, I'm not familiar with it.
Okay. Can you clarify what is a dividend income investment versus bank mutual funds or GICs? Thanks.
Well, first of all, a dividend investment could be a mutual fund. There are mutual funds that focus on high dividend paying stocks, as there are ETFs that focus on high dividend paying stocks. And I'm going to talk about that a bit more in week 3. A GIC is simply an interest payment type of investment. There's no capital gain. You're guaranteed a certain amount of interest, and that's it. The benefit of the GIC is that it has the guaranteed aspect to it. So what you contract for is what you get. And it is very, very secure because it's guaranteed up to $100,000 per institution, per person by the Canada Deposit Insurance Corporation. So it's a guaranteed fixed interest investment for a fixed period of time. Dividend investing, it comes from typically individual companies. There's no guarantees, and they typically are sold either by buying individual stock companies. For example, Enbridge at the moment pays a dividend of about 6.5%. And when you typically gross it up to take into account the tax advantage nature of a dividend, that's equivalent to interest of almost 8%. But there's risk involved. So very different animals. And I think that's about as much as I can to explain the difference. But again, week 3, we'll be delving into it a lot more.
And I really encourage participants to register for week 3, because I think that will provide a lot of very useful information and advice in this very challenging time. Now, we do have a reply from Christian De Silva regarding the BTSX. It's a listing of the 10 best dividend paying stocks. It is recalibrated every year, so one can just adjust holdings based on the recalibrations. It appears to beat other dividend strategies in most years.
Yeah, I mean, that could well be a good way of doing it. I don't know who picks it or how they do it, but there are a number of ways of doing that sort of thing. For example, there's a few ETFs that are focused simply on the 25 best dividend payers. One is called XDV by iShares, and they only pick companies that have a history of paying and increasing their dividends for X number of years. So there's a number of ways of approaching this, but these, if you want dividends, are probably reasonable strategies to look at. Again, it depends on the fee. How much is the fee? In the case of XDV, the fee I think is around 0.5, 0.5%, just to give you an example. And that's probably a reasonable amount to pay for somebody to manage the fund.
Now, earlier we spoke a little bit about some macro developments. Do you see the Canadian stock market is better than the US currently, given the low dividend yields on US stocks?
Well, there you're getting into advice and opinion and predictions. And as a famous personality once said, it's very difficult to make predictions, particularly about the future. You know, at the moment, the Canadian stock market is significantly cheaper than the US. There's no doubt about it. And it pays higher dividends. However, if you look at history, the US stock market over time has outperformed the Canadian. And this becomes a guess about which economy is going to perform better. I lived in the United States for quite a number of years, 3 different cities. And the one thing I have always been impressed with the United States is the ability of companies to produce wealth and to innovate. And if you look at all the big name companies in the world, the huge innovators over the last 10 years, whether it's Microsoft or Google or Amazon or Netflix or whomever, they're all out of the United States. So I don't know which is better. My personal approach is to own both, but we'll see.
Now, we talked earlier about GICs, and this may be a question perhaps better directed towards one of your future presentations, but some banks offer a GIC with a minimum interest, fixed and market performance over time. This product at least offers an upside to cover inflation. The market can be Canada or the US with hedge currency. Your thoughts on this?
Yeah, they're interesting products, and they are interesting to a lot of people because they seem to come with guarantees. As I understand them, there are 2 issues. One, they tend to cap the upper range of the returns compared to just owning the stocks outright. And second of all, the fees that are embedded in them are high. And again, it goes back to fees. So you have to take a look at what you're getting for your money and what the long-term likelihood of the stock market doing anything is. And of course, your own risk appetite. And we're going to, as I say again, talk about that in week 3 a bit. But for some people, it may be an option that gives them a better feeling of security. But none of this comes for free. I remember back a couple of years ago, I was doing a seminar and somebody approached me and said, look, I've got this thing from the bank of something similar to what you're describing here. He said, and there's no fees. They're not charging anything. And I said to her, ma'am, they're charging fees. They're not doing this because they like you, as much as you are a very nice person.
Thanks. That's wise advice. We've come to the end of our questions. I'm just wondering if anyone else has any questions which they can submit in the chat box. In the meantime, Michael, is there anything you'd like to go back to which you either have discussed in the last 45 minutes or which you haven't and you think is worth raising today?
Well, no, I think just to reiterate the basic point, it goes back, Paul, to a briefing I went to the Marine Corps several years ago, and the briefer got up and he said to me, first, I'm going to tell you what I'm going to tell you, then I'm going to tell you, and then I'm going to tell you what I told you, because that's how we brief in the Marine Corps. Anyway, so going back to what I said, I think that we are into a low return environment at the best over the next few years. I think that interest rates are going to continue to increase as the central banks fight the inflation, which, by the way, they and government overspending created. And I think it's going to be a very difficult time. And so fees becomes absolutely crucial. You got to keep your fees low. So whatever you invest in, the first question to ask is, what are the fees? I see there are a few more questions that have popped up there, Paul. Do you see them?
Yeah, you've mentioned a lot of positive things with regard to ETFs. Are there any cons?
Not really. The only con is that when, let's say you set up a discount brokerage account and you're buying them, every time you buy them, you will have to pay a small fee. Typically in Canada, it's $9.95 to buy or sell an ETF or a stock, no matter how much you buy. So whether you buy $1,000 worth or $100,000 worth, you're going to pay $9.95. So what that means is you don't want to be making a lot of small purchases. Where with mutual funds, there's typically no fees involved in buying them or selling them. So in some cases, mutual funds, particularly index tracking lower fee mutual funds, may be better for people who are investing a small amount of money. However, there's now a number of online brokers in Canada, such as Questrade and Wealthsimple, who allow you to buy ETFs at no fee, no cost. Other than that, ETFs and mutual funds, the only thing that's different really are the fees.
Okay, and here's a question which might come up in one of your subsequent sessions, but if you could answer it today. One of our audience asks, if you move RIF money to a TFSA, is this taxable money?
Yep. Anything, people are surprised to learn that when you take money out of your RSP or RIF, that's taxable. There's a lot of people who thought that that money is not taxable. It is taxable. Not only is it taxable, it's taxable at the highest rate of taxation. It's taxable the same as income, taxable the same as interest. And depending on what your income is, you can take a pretty big tax hit. So at any time you take anything out of a RIF anyway, you pay full tax on it.
All right, thanks, Michael. That's very sobering advice. There being no further questions, I'd like to thank audience members for their participation in today's webinar, and a huge merci to our presenter, Michael Fine. I want to remind you to keep an eye out for our follow-up email, which will include information on how to access the recording of today's webinar and information about the Mega Recruitment Drive. We hope you will decide to participate and refer us new members. Ottawa branch needs your help to grow so that we can continue to offer great webinars and other benefits to our members. Remember, you can invite non-members to attend our webinars and try us out as a guest. To register for the next two webinars from Michael Fine or other upcoming webinars, please visit the Ottawa branch website at www.nafrottawa.ca. Thank you, and see you at the next webinar. Merci beaucoup et au revoir.
Thank you, Paul. Excellent job. Well done.
Thanks, Michael.